All right, so every quarter there's this one number that everyone in the financial world holds their breath for. It's called earnings per share, or EPS. It's supposed to be this super simple metric, right? How much profit a company made for every single share out there. But what if I told you that number isn't always the real story? What if it's not the whole truth? That's what we're going to dig into. You know, at its core, the idea is actually super simple. Let's say you own a bakery and it pulls in $1,000 in profit. If it's just you, hey, that's all yours. But now let's say you bring in a partner to help out. Suddenly you're splitting that profit, right? 500 for you, 500 for them. The bakery still made the same amount of money, but your slice of that profit pie just got cut in half. And that, in a nutshell, is what earnings per share is all about.
Okay, but here's where things start to get, well, a little tricky. Because a giant corporation isn't exactly a small town bakery. What if the numbers they're showing you are more like a magic trick? You know, a bit of financial sleight of hand designed to fool you, the person putting your hard-earned money on the line.
And this isn't just a hypothetical. Let's look at a real-world case from back in 1970. The Aluminum Company of America, ALCOA, they put out their annual report. And buried in there, you wouldn't find just one EPS number. Oh no, you'd find 4 different EPS figures for the same year. And depending on which number you looked at, the stock was either a total steal or ridiculously overpriced. So, which one was the truth? So to crack this case, we need to bring in the master, the original financial detective himself, Benjamin Graham. See, he saw this coming decades ago and warned investors about what he called 3 booby traps, these sneaky ways companies play with their earnings. And these traps, they're the clues we're going to follow to get to the bottom of this. So what are these 3 big traps? First, there's dilution. That's when your piece of the pie gets smaller and smaller. Then you've got special charges, a sneaky way to bury bad news. And finally, there's a whole grab bag of accounting gimmicks, basically a corporate shell game. Let's pull back the curtain on each of these one by one.
All right, first up, dilution. Let's go back to our bakery for a second. Imagine you told some people, hey, down the road, you can become a partner too. That's kind of what companies do with things like stock options or convertible bonds. And when those people decide to cash in, it's like a bunch of new partners suddenly walking through the door of your bakery demanding their share. The profit is the same, but now it's being split even more ways. Your slice just keeps getting thinner. And don't underestimate how big of a deal this is. I mean, we're talking about a company's EPS potentially dropping by 1/3 or even more. That's massive. And it's not some weird edge case. This happens all the time. So here's the key takeaway. The number 1 rule. You always have to look for the fully diluted EPS. That's the real number. It's the one that pretends all those potential new partners have already shown up and claimed their piece of the pie.
Okay, trap number 2 is something companies love to call special charges. And Benjamin Graham had this brilliant, kind of poetic way of describing it. He said it was like a sundial that was built to only count the sunny hours. It just ignores all the cloudy days. And that's exactly what companies are doing. They have a big loss, something goes wrong, and they just label it a special, one-time thing that you, the investor, should totally ignore. Nothing to see here. So here's how the game is played. A company is already having a pretty bad year, right? So management thinks, hey, let's just throw everything bad in there. They call it a kitchen sink here. They dump all their problems, restructuring costs, closing a plant, whatever, into that one year. It looks terrible on paper, a huge loss. But what they've done is they've wiped the slate clean. Now for the next few years, their earnings are going to look fantastic, artificially great. The trick for you is to realize if a company has a special charge every other year, well, it's not so special, is it? And that brings us to trap number 3, the good old-fashioned corporate shell game of accounting gimmicks. This is just pure magic, but not the good kind. Check this out. The train company once boosted its earnings by a whopping 20% in 1 year. So, did they sell a ton more air conditioners? Launch some amazing new product? Nope, not at all. They just changed an accounting rule. They tweaked how they calculated depreciation. That's it. No extra sales, no new business, just a few keystrokes on a spreadsheet.
So, I know what you might be thinking. Okay, that's all interesting history, but that was Graham's time. Things have got to be more transparent now, right? Well, not exactly. The truth is, the tricks didn't go away. They just got more sophisticated. The accounting nightmares we saw during the dot-com bubble proved that this problem isn't just still around. It might be worse than ever.
And the biggest, scariest monster of the modern era? It's called pro forma earnings. Honestly, this is a number that's just made up. It's Fantasyland accounting. Companies literally present figures and say, here's what our profits would look like if you just ignore all this bad stuff that happened. It's like taking a math test, getting half the questions wrong, and then just erasing them and telling your teacher you got an A+.
And you won't believe some of the examples from that dot-com era. I mean, it's just wild. You had BEA Systems reporting profits as if they didn't owe almost $200 million in payroll taxes. You had JDS Uniphase pretending a $2.5 billion charge just, poof, vanished. We're not talking about small tweaks here. We're talking about companies trying to turn catastrophic losses into fairy tale profits.
So, what are you supposed to do when a company hands you these pro forma numbers? Well, Jason Zweig, the financial journalist who did an amazing job updating Graham's classic book, said it best. And it's really simple. The only thing you should do with pro forma earnings is throw them right in the garbage. Just ignore them. They're worthless. But the creativity didn't stop there, oh no. Take Quest Communications. They had this clever little trick. They sold ads in phone books, remember those? And customers would pay them over the course of a year, in monthly installments. But Quest decided, nah, let's just pretend we got all 12 months of that cash on the very first day. Just by doing that, they juiced their income by $240 million. It should come as no surprise that the company, well, it didn't end well.
Okay, so I know this is a lot. We've gone through all these tricks, all these traps. It can kind of feel like the whole game is rigged against you, right? But here's the good news. It's not hopeless. Because Graham didn't just point out the problems. He gave us a toolkit, a timeless set of rules that lets any of us become a financial detective and find out what's really going on.
So here are the 3 big tools for your detective kit. Number 1, always use the fully diluted EPS. No exceptions. Number 2, when you see one of those special charges, don't ignore it. You add that cost right back in. And number 3, and this might be the most powerful one of all, stop looking at just 1 year of earnings. You've got to average them out over a long stretch, say 7 to 10 years. That smooths out all the bumps and the games and gives you a much clearer picture of the company's real earning power.
And you know what? Using this long-term view brings us right back to that mystery we started with, ALCOA. Because Graham did exactly this. He averaged the numbers out, and what he found was incredible. Over a decade, ALCOA's earnings had actually grown faster than the darling of the stock market at the time, Sears. I mean, Sears was the Amazon of its day, but according to the long-term numbers, ALCOA was the better performer.
And yet, look at this. The market was paying a totally different price for these two companies. ALCOA, the company with the better growth, was trading for just 11 times its earnings. But Sears, people were paying 27 times earnings for it. It's a huge difference. What does that tell you? It shows that the market had completely lost confidence in ALCOA's story, even though its past performance was great. It's a perfect lesson that just because a company grew in the past doesn't mean the market will pay up for it in the future. So after all this digging, all this detective work, what's the one big lesson we're supposed to take away from this? It all comes down to Graham's single, most famous, most important idea. It's the one concept that acts as the ultimate safety net for anyone who wants to be a smart investor. And that principle is the margin of safety. It's such a simple but powerful idea. It just means you have to figure out what a business is really worth, after you've corrected for all the accounting tricks. And then, and this is the important part, you only buy it when it's selling for way less than that true value. That gap, that discount, that's your margin of safety. It's your cushion. It protects you if you made a mistake, if something unexpected happens, or if the company's management just can't stop playing games. Look, as Graham himself said, you just can't take the numbers companies give you at face value. A valuation you can truly depend on, that's actually pretty rare. You've got to be a skeptic. You've got to do the homework and always demand that margin of safety to protect yourself. So let's recap the mission briefing for our financial detective agency. Rule 1, always adjust for dilution. Rule 2, special charges are almost never special, so count them. Rule 3, see how a company's accounting stacks up against its competitors. Rule 4, use that 7 to 10 year average for earnings. And Rule 5, maybe the easiest one, pro forma earnings are total garbage. Ignore them. At the end of the day, a company's financial report tells a story. The big flashy numbers on the first page, that's just the headline. But the real story, with all the secrets and all the warnings, that's buried in the footnotes, in the fine print. So the only question left is, are you going to read it?